So again, thanks everyone for joining me here today. Again, I'm going to be talking about risk control indexes, low volatility indexes, as they might be called in some products. What do they mean? Why are they important? What's the history of some of them? I'm going to focus primarily on one that was derived from the S&P 500. It's generally called the Mark V. It is called the Mark V, and just go through that. If you have any questions, feel free to ask it with there should be some functionality for that. And this is my first time using the Zoom webinar, so apologize if there's any problems or anything like that. Yeah, so I'm glad everybody could make it today. Again, Jordan Pence Advisors Resource Company, and now it's 11 o'clock right now, and go ahead and get started. So all right, let's go right into it. So what is the Mark V? That's going to be the first section of this. I'm going to go over how does it work, what does this mean, and how will it perform? What's the historicals on it? And why insurance companies have started to or have considered utilizing this index. So what it was or how it works, why it was created is really it's designed to create a more stable index through diversification and managing volatility. And the Mark V in particular utilizes an algorithm between equities, which S&P 500, this was derived from the S&P 500. They're using effectively 10-year treasury notes and gold futures, basically, but gold, let's just say commodities. And so what they're doing is based on the volatility in the S&P 500 or the stock market, they're moving assets out of the S&P 500 and into these various options. The idea behind that is when volatility goes up on various products, so like let's say the S&P 500, they change the allocations, and effectively this is how the algorithm works, and it's basically an algorithm. The more volatile each asset is, or individually assets are, the more they will, or the less they will weight. So if volatility goes up, they weight it less. They're trying to target really 5%. That's where you get the 5%, Mark V. They haven't exactly hit that perfectly over time, but that's the target. So you'll see what some of the histories in a little bit, but they're able to reduce some of the volatility of the S&P 500 by moving from the S&P 500 into these two other asset classes when the volatility increases. So it's a little bit complicated. It's all effectively automated. It's just an algorithm. And when you compare that to other indexes in the same category, it actually performs pretty well. More on that later. Why this is important for index products, or why this is useful for insurance companies with regard to index products, is because it has a lower volatility, and that volatility is very controlled. The cost or the expense to hedge this is not nearly as much as, let's say, an S&P 500. S&P 500 can be much more volatile, so option prices are quite a bit larger. They're just higher. Option prices are more. So because of that reason, you can have, in theory, a much higher cap. Most of them aren't capped. You could have a higher participation rate. Generally, for the client, you're going to see more consistent returns. And because of all this, the bottom line is, compared to maybe a straight index like the S&P 500, in theory, you should have higher crediting rates on the policy, the annuity, so on and so forth, whatever you're utilizing in that particular case. So effectively, the lower cost to hedge, because of the lower volatility, lower option costs, the better, or the more the insurance company can give to the client. So how will this perform? This is actual historical data. One thing to note, and I'll actually address this in a little bit, is in 2017, this was actually, I guess you could say, invented or created. So prior to 2017, all of these results are back tested based on their algorithm, like how that would work out. So this is the performance of $100 invested in the Mark V, which is in blue, and $100 in the S&P 500, the overall S&P 500. And this is just simply demonstrating how the Mark V performed compared to the S&P 500. Obviously, the S&P 500 blows it out of the water, but you'll notice the stable nature of this type of index. It's very consistent, not many or not a lot of negative years or not a lot of downturns. It's designed to be very low volatile, hence the name. I mean, that's why they call these low volatility indexes. So let's go to the history of it, how it compares. What we want to do is look at some various other indexes in the same category. And you can see the 1 year, may be an anomaly because this does have S&P in it. Last year S&P kind of blew the doors off. I mean, the S&P 500 did really well, but when you compare this to the 3, 5, 7, 10 full period, which is from 2001 to 2019, you can see that this Mark V strategy overperformed in really all years, excluding the 7-year. So this really overperforms all of the, at least the average for this group. So it's a really stable index, is high performing. This is why some companies are starting to add this index. This actually came straight from S&P's data that they have, and there's a little bit of a zoomed in look for you, but the bottom line is this has a pretty good history. In addition to that, this is some more information that they had, but this is compared to other volatility indexes, volatility control indexes. And really, you can see effectively back in 2019, we were able to, 2018, the end of 2018, this Mark V strategy really avoided some of the sell-off in that year. And, this is just kind of demonstrating it compared to the best and the top of the group and the bottom of the group. And then obviously the average. So you can kind of get an idea for the performance of this as compared to the rest. I mean, if you look at the first couple months, they're all pretty close to identical. But the point of all of this is just to simply reiterate the performance history of this product, how it compares to other, quote, volatility control indexes out there, and the fact that this one may be one of the better ones. We'll have to look 5-10 years from now back and see how it performed over that time period. So we don't exactly know, but based on this, we have a reasonable belief that we're going to have some decent performance. I would say, at least. And there's a zoomed in view. You can really see that dip with all the alternatives after October 2018. And then the Mark V kind of taking off from there. So, they all pretty much track similar ways, but there was a big difference there. And that's basically comes down to their algorithm on how they're switching in and out of these various asset classes. So this is one caution that I'll bring to all of these, really, but primarily this Mark V. Now, the biggest problem that I see with this is this was created in 2017, and all of the history that we have for it is based on how they created it in that year. So the problem is, if I was trying to design an index and I have all this back history, I could very easily tailor it to whatever I wanted it to perform. That's a bit of the problem here. So now, if history repeats itself and markets do similar things, then this will all work out. But as they'll always say, or as they almost require you to say if you're doing investments, historical performance is no indication of future results. So one of the problems with this is, yeah, it worked for the past 30 years, 40 years, whatever it was. I think the testing that I have goes back to I think it's 89, so approximately 30 years. Yeah, that worked for all that time period. And now, is it going to keep working going forward? We'll see. Hopefully it does, because if it does, and you'll see in a little bit, what this means for insurance products, specifically index products, is very strong performance. I think I'll share with you those numbers from our software here in a little bit. But anyways, I just wanted to caveat all of what I've said on this, and that's primarily the fact that, look, this was developed for this type of reason, and they were able to look at history and say, okay, we can tailor this. We can get our algorithm just right to make it perform in history however we want. So we'll see if it continues. I think it will, but that's yet to be seen. I mean, it's hard to know. So what I did was, I wanted to take some indexes from a company that we work with. They actually have this strategy, the Mark V, American National. They added it back in July. And so what I did was, I put together, this is actually I really like this presentation, but this is a presentation that we have come up with. And what it does is, it goes back to the most history that we have for each of these indexes. So like the Mark V, I go back to approximately 1989, 1988. The NASDAQ, I go back to, I think it's 1980. And then I included a multiplier strategy on the S&P 500. We go back to 1975 on that one. We have the most history on that. But what we do is, of course, we provide the generic last 20 years performance, but this particular presentation here is showing us, well, what was the best, worst, and the median of that period of the history that we know. Now, this was, like I said, back to 1989 or 88. I'll have to get back to you on that, but this is the Mark V. So the Mark V in American National's product is 150% participation. So the Mark V times 1.5, no cap, and a zero floor. So this is, if you told me that on any index, I'd say that sounds fantastic. They're able to do this primarily because of the low volatility, so it's cheap to hedge. I mean, obviously, if you're going to provide that much upside, it better be pretty cheap to hedge. So it's cheap to hedge. That's number one. But number two, they've rolled this out because of this, and this is all the history that we have. So the middle, or the median, which is if you line up all the results in a row from smallest to largest, the one in the very middle is this one, and the return was 7.77 over that 20-year period. Now, this is obviously back tested performance, so take that for what you will. But 7.77, this is after the 1.5, you could say, participation rate. So that's pretty good. I mean, and this is actually almost exactly what the average is. The average is nearly identical to that. So that tells me it's a normal distribution. But anyways, that's beside the point. The worst 20-year period was 6.6. I mean, 6.6, I'd be happy with that in my index product, really. I'd be happy with, 5%. But 6.6, that's pretty good. And then obviously the best is 9.2. So the range of outcome is going to be somewhere between six. Well, it could be worse than that. It could be better than the best, but let's just say, at least from what we've seen in the past, the worst is 6.6, the best is 9.2. And most of them are going to be closer to 7.7. So that's pretty darn good if you ask me. Oh, I wanted to zoom in on here. So yeah, you've got 6.6 as the worst, the 7 point, let's just say 8 as the middle, which is very close to the average, and then 9.2 is the best. Moving on from there, I wanted to let me just silence this. Sorry, guys. But moving on from there, I wanted to also include an index that I think is relatively unique. This is an American National Index, but this is the type of analysis that we put together. This is the NASDAQ 100, more of a growth-oriented index. And what it is a floor of 0, cap of 9.5. And you can see the performance here. The worst is about 5.5. The middle 6.5, 7.6 is the best. So much tighter, a little bit lower average, and those are the results of it. So, this isn't a bad option. I mean, I would probably blend some of if I was doing a policy on myself, I might blend some of this in there. I think this is a really good option. It's going to perform differently than the S&P 500 because we all know the NASDAQ index is more the tech oriented type stocks and things like that. But that's effectively how that works. And then finally, I wanted to bring up the multiplier strategy that they have, and this is the essentially the returns after you apply the multiplier to it. So and apply the expenses. So it's applying the expense and the multiplier. But this is a pretty close story to the Mark V. You've got the worst 20-year period at 5.5. The middle or the average is 7.9, almost 8. And then the best is 10.7. So I just wanted to throw this one in here just to demonstrate how we put together this type of presentation with regard to doing the analysis for these types of indexes. So just wanted to go back real quick. Mark V, again, worst 20-year period, 6.6, middle 7.7, best 9.2. I mean, this thing's hard to beat. Looks really good. We'll see how it performs in the future. I suspect it's going to do really well. Some people are a little bit skeptical of these things, and I'd recommend maybe putting 25% of an allocation into it and then do some other S&P strategy or the NASDAQ strategy. So anyways, I think this is a really good story. I think it's good that they're adding these types of indexes. And, what I like about this one as compared to some of the others that I've seen is it's not like a proprietary index. Some companies have these sort of blended indexes where they've come up with whatever algorithm on their own. This is an S&P product. It's not necessarily something that's derived from any insurance company. And so finally, I wanted to just bring in why this goofy guy here, but why consider American National for this type of product? We use American National in their IULs quite frequently. And one of the reasons is obviously this Mark V, this is a new strategy, 150% participation, no cap, pretty strong. But here's something that I think is extremely interesting. The cap on their multiplier strategy, they just raised it. The multiplier strategy that I showed here, it was a 0 floor, 11.5 cap, and a 1.6 multiplier, and the fee is 3.65. Well, they raised it from 11.5 to 12%. And not only that's not just on new business, that's on all of the policies that have been issued in the past. So that's something relatively unique. I mean, there's other companies that do that, but I think that speaks to kind of the appreciation for the in-force business. I've seen plenty of companies, wall off their existing business and lower the caps on the products that were issued in the past. In addition to that, they reduced the spread on their uncapped strategy. They have an uncapped S&P 500 strategy, zero floor. The spread right now is 6. It was 7.75. When volatility goes up, it costs a lot more to hedge that. So they had to raise the spread. Now that volatility's gone back down, they've lowered the spread. I mean, it's fantastic. And just as it says there, it's not just going to affect the policies that we're writing right now and marketing right now. That's going to affect, well, that has affected already all of the in-force business, which I think is just fantastic. So anyways, I appreciate everybody joining me today. I hope you found this informative and interesting. I'm really excited about some of these low volatility indexes. I think they'll really be a good opportunity for clients to more diversify their index products. And in theory, well, in actuality, I guess for the past 3 or 4 years, receive a much higher return than they may have in some of the capped products. So I think it's a really good opportunity. If you have any questions, feel free to write me an email. You should have my email address, but there will be a follow-up email that goes out to everybody. So feel free to reply to my email. You can talk in the chat if you wanted to. You can feel free to ask some Q&As or anything like that. But anyways, I'll stick around for a few seconds. But feel free to shoot me an email or give me a call. The number here is 972-338-9655. My extension is 102. My email address is just simply my name, Jordan Pence, as you see on the screen, at advisors-resource.com. Just like Advisors Resource Company. And feel free to shoot me an email. If you get on our website, you can just book a call with me if you'd like to. There's a couple links on there to do that. But I'll send out a follow-up email and we'll go from there. Hope to talk to everybody soon. Thanks.